I think that the weight of money argument is a big factor behind these falls. And I do think, though, that the narrative that both, Total, which have obviously bought into charging points in London very recently, Shell, BP, I think the narrative around renewables is slowly going to gain traction. I think the market is still in a kind of show me kind of mood, because I think there is the concern that they're all chasing the same assets, they'll all overpay for these assets, and returns as a result will be much lower. But I do think there's a narrative that will build over the next couple of years that will, I think, attract investors back into these stocks. And on the flip side, one could sort of postulate that actually the oil price is pretty well underpinned, because part and parcel of the pivot into renewables is you're only talking about companies that will be maintaining capex rather than finding new finds. And we know that depletion rates in oil fields is probably 4%, 5%, 6% per annum, and that's probably going to outstrip the fall in demand for fossil fuels. So you've got two things. You've got, I think, an oil price that will ultimately be supported by the lack of new finds, and secondly, you will have this pivot into renewables that will, I think, ultimately attract new investors back into the sector.
Alan, your comments so far have been somewhat positive around a vaccine and around investor support for energy. I want to just turn to Bayer today and not necessarily talk about that particular stock, but the message it is sending is that its core EPS next year will be below this year's level. And it's citing in particular declining demand in agricultural products. We know the bulk of companies for next year have been talking about some sort of revenue recovery, that EPS should be maintained and better numbers should start to cross as we take out these woeful quarters with severe lockdowns. But the message from Bayer is that 2021 may not be that rosy. How concerned should we be that this is an early warning sign, the canary in the coal mine for other companies around EPS for next year?
Yeah, no, I think that's a very good point, Karen, and I think we saw it yesterday with Compass as well, who optically their numbers look very good, but actually the guidance for 2021 was actually pretty weak. I think as we sit here, we look very much, I think, at 2022 as the first sort of clean year to look at. I think 2021 will still obviously have the impacts of COVID in their numbers, and so I think that the market, that's one of the reasons why I sort of picked 2022 for Royal Dutch Shell rather than necessarily 2021. But, the flip side of that is we roll forward 4 months. The front year then we're starting to look at is 2022, not 2021. But I do think that, the V-shaped recovery we've seen thus far clearly has the potential to stall. We're obviously talking about much more significant restrictions in terms of movement. So I do think 2021 is going to be a very volatile year in terms of earnings expectations, much in the same way that this year was, with analysts underclubbing numbers quite significantly for the impact of COVID. I think companies generally are in a much better place in terms of being able to cope with the challenges of COVID. And clearly, if we were to enter a second lockdown, then I think companies, again, would be well positioned. I mean, I actually was listening to a call with Greggs, which we all appreciate as a sort of high street sort of food, fast food restaurant. And they said, interestingly enough, that when the new restrictions came in last week, they saw sales fall off for one day, and then they recovered back the following day to exactly where they were before the restrictions. So I think it feels like we've found a base level here, and in the absence of a full stay-at-home orders, it doesn't feel like necessarily we're going to see significant headwind to forecasts from this level.